Ladies and gentlemen, good morning and welcome to our second day of AqabaConf 2019. We hope that you spent a lovely night yesterday and enjoyed the music at the dinner party. Today is our second and last day of AqabaConf 2019, and we will cover different topics today and meet some new expert speakers who will enrich us with lots of valuable information. Our speakers will deliver 4 interesting presentations that highlight on 2 important topics: natural catastrophic exposure and risk versus capital. Mr. Pierre Salameh, Senior Vice President, CCRE, will be the head of session for the first topic of this session, the NAT CAT Pricing. Mr. Salameh will introduce us to the speaker of this topic and brief us about her presentation. Please welcome Mr. Pierre Salameh.
Graduate from EDP University Department of Mathematics with a full scholarship. Joined Milli retrocession department in 2008 for conducting internal dynamic financial analysis studies for Turkey earthquake. Participated in a number of seminars on insurance, reinsurance, pricing, solvency, economic capital calculation, financial and catastrophe modeling organized by leading international reinsurance and broker companies. Conducted economic capital modeling, exposure management task in addition to her role as an underwriter. Esen, the floor is yours.
Thank you very much.
Please.
Good morning. This is Esen Temiz Onal. I've been working for the industry since 2008, and I'm heading the retrocession department of my company. Therefore, the majority of my responsibilities are related with the management and control of the exposures of my company. Is this better? Yes. Okay, thank you very much. And I was mentioning that most of my studies are related with the management and control of the exposures of my company, and also with the CAT modeling. So today I will be sharing some basics of the catastrophic pricing. It is always better to start with the lexical meaning of the topic. The lexical meaning of the natural catastrophe is a sudden and terrible event in nature that usually results in serious damage and many deaths. However, the meaning in respect of the insurance industry is slightly different than the lexical meaning. So, there is a risk as a consequence of a natural catastrophe only if the society and or economic values are affected by that disaster. So if we consider that statement from the opposite direction, no matter how severe a catastrophe is, if there is no one or no values are affected, then it is acceptable to state that there is no risk. So from the insurance perspective, the term natural catastrophe refers to an event caused by natural forces. Such an event generally results in a large number of individual losses involving many insurance policies. The scale of the losses resulting from a catastrophe depends not only on the severity of the natural forces concerned, but also the man-made factors such as building design, or the efficiency of the disaster control in the affected region. So, in definition, the natural catastrophes are high severity and low frequency losses. And these losses are dependent on some factors, so it is also possible to say that CAT prices are also dependent on some factors. These factors can be categorized as the internal factors like the perils, the potential losses, the risk profile of the company, whereas it is also possible to mention the market cycle is a major contributor. However, this is an external factor which is contributing to the CAT price. I would like to have a look at the components of the catastrophe risk premium. The annual expected loss is a function of probable loss severity and frequency, which is calculated by using companies' related exposures in respect of the relevant peril in conjunction with the policy conditions, like the sums insured, policy limits, the original deductible, the coinsurance level, and the underlying covers, if any. The expense load is also known as the admin cost, which is, I will manage to do that, most probably. No, I couldn't. The one on the left-hand side, on top, is the expense load. Is also known as the admin cost. It's the combination of startup costs, underwriting expenses, acquisition costs, and etc. The other part of the catastrophe risk premium is the uncertainty load. In this way of looking at it, catastrophe risk, in this way of looking at the catastrophe risk premium, the profit margin is evaluated as a part of uncertainty load. However, in some resources, it could also be considered as a separate component apart from the uncertainty load. In more detail, the first contributor of the catastrophe risk premium is the annual expected loss, which is also known as the pure premium, and it is the average annual loss over a long horizon of time. AEL depends on the frequency and severity distributions considered and determined by historical data, as well as the loss scenarios embedded in the models. Considering the sums insured per cresta, or in more detail, for instance, like the geocoded data, on a Z basis, in conjunction with the policy limits, the original deductible percentages and coinsurance, an analyst could be able to calculate the annual expected loss of a company. And the second part of the catastrophe risk premium, as we mentioned, is the expense load. The expense load is a combination of all non-related costs, like the underwriting expenses, the claim adjustment costs, and it is to some extent inclusive of the startup costs of a newly established company, but it takes just a couple of years' time. And also for a reinsurance company, the retrocession expenses will be reflected to the expense load for the insurer as well. The uncertainty load is a margin to compensate the reinsurer for limited information or uncertainty associated with writing a specific insurance line. For those lines covering large, infrequent events, and even more frequent events in countries where the quality of data is poor, the uncertainty load can be a significant component of the premium. So the volatility load is the amount charged to compensate the reinsurer for bearing risk. The cost of equity capital compensates the reinsurer's shareholders for placing their capital at risk. The cost of capital can be viewed as an opportunity cost. That is, by placing their capital at risk in the reinsurance business, the owners of the companies forego the opportunity to invest their funds elsewhere in the economy. So we can wrap up that as this load is an amount over the cost to generate the risk takers, the reinsurers' profit. There are many CAT PML estimation methodologies used in different countries for different perils. Most of them, most widely used them, apart from the general PML application, are the statistical approaches. The in-house models generated by the companies in conjunction with the scientific studies, with the universities, etc. And also the vendor models, which most of the reinsurers are relying on. And there is another way of looking at it, which is the standard formula. We can give an example as the Solvency II approach, which applies for standard exposure type, some standard percentages, and make a calculation on the CAT PML estimation. After talking about the PML valuation methods, I would like to focus on a vendor model output and how to read it, how to focus on the model outputs, so that how we can proceed from looking at a model output and achieving a CAT price. As you can see, this is an example output from a single cedent's property portfolio. It is on comparative basis for 2 consecutive years for the third quarter 2017 versus third quarter 2018. When we see the mean loss here, the mean loss stands for the AE, as we previously mentioned, which is the average expected loss over a long horizon of time. And we need the standard deviation in order to evaluate the uncertainty load part of the price. And we also have the return period losses, where we can fix our worst case scenario looking at the return period losses. So there are 2 ways of looking at the model outputs. One of them is the OEP. The OEP is often used by the primary insurers to help to determine their reinsurance cover limits, as well as their retention limits. Whereas the AEP, which stands for the aggregate exceedance probability losses, represent the total amount in a year and usually used for pricing and also for the exposure management purposes. I know it is a little bit theoretical, but before digging more into the pricing, I would like to share some definitions we use for the stochastic modeling. First of all, we will touch upon the return period. We always see the entry years, the exit years, the midpoint years, etc. The entry return period means the probability of a loss hit to a single non-proportional CAT program. It can be represented in years term, let's say 1 in 50 years, 1 in 250 years. And also, it can be represented in respect of the probabilities as well. So, if we are talking about the return periods, then it means we are referring to the years. And if you are referring to the probability of loss hit, then we are talking about the probabilities, hence the percentages. So there are some key indicators as the entry point, the midpoint, and the exit return period. The entry means the probability of loss hit to a program. The midpoint means the probability of 50% loss hit to a program, whereas the exit return period means the probability of a total loss to an excess of loss program. So how we calculate the technical rate online if we have available stochastic modeling outputs? The technical rate online stands for the recoveries divided by the limits of the program. It means, it is very basically, it means that the aggregate loss burden over a year period divided by limit, which is the loss burden on the reinsurer side. So this is how we calculate the pure technical rate online. However, if there is a paid reinstatement element condition within the treaty, then the number of premiums has to be also considered while calculating the technical rate online. Another factor playing an important role, as we earlier mentioned, the standard deviation, which will show us the volatility in the losses. So, to conclude, the market rate online, looking at a stochastic modeling output, will be calculated by considering the technical rate online and loading it up with a risk factor multiplied by the standard deviation of that rate online. So, let's consider a very simple example. We have an example seeding company, which we referred in the earlier slide. They used to have a 1 in 250 years return period loss of 189 million in the previous year. All the limits, deductibles, reinstatement remained exactly the same for 2019's renewal. However, there is only one change, which is the underlying exposure. We understand that there was a decline in the underlying exposure of the company, so that their 1 in 250 year return period loss decreased to 163 from 189 million. So what do we do next? As we have the modeling outputs, we can then, using the formula we have a look at earlier, we can then calculate the technical rate onlines, the standard deviation of that specific program per layer. And also on top of it, we already know the market rate online coming from the previous year, which is the actual rate online of the program. So, coming back to the earlier slide, using the risk factor element here, it is easy to calculate the risk factor applied by the reinsurers on top of the risk premium in order to capture the volatility of the premium element, which stands for the profit margin as well. So, I would like to touch upon the risk-adjusted flat pricing methodology. This is how we do it, given that there is a market rate online of 4.5% in the previous year for the first layer. And we know the company's exposures are declining, whereas the mean losses are declining by 9%, and the modeled losses in respect of the worst case scenario, in this case, which is 1 in 250 years, are declining by 14%. Then, if the insurance company is well prepared to pay a risk-adjusted flat rate online, then the calculation will show us that the rate onlines will be declining from 4.5 to 4.01 for the first layer, And for the second layer, they will be declining to 1.6 to 1.4%. In other words, the risk-adjusted pricing is the answer to the question, what will be the price of the layer if all contributors, apart from the pure loss element, remains exactly the same with the previous year? And I also would like to mention that the recoveries that we are referring here are the mean losses we covered earlier over a one-year period. So, by this calculation, the reinsurer takes the pure premium from the insurance company. On top of it, for the volatilities they will carry, they add on top of it a volatility factor, which is given by the market risk factor. However, if there is an abundant capacity coupled with free loss records, then the buyer would expect a soft market environment. In this case, the cedant would be able to purchase the same level of cover with a risk-adjusted cost decrease. In comparison with the previous slide, we saw that if the company is prepared to face with a flat pricing, then it is always better to focus on the existing risk factors. However, as mentioned, if there's an abundant capacity and if the market cycle is going to the softening side, then the risk factor will be decreasing in comparison with the previous year. Hence, the market rate online will be decreasing as well. On the contrary, if the level of available capacity declines in comparison with the previous year, then the reinsurance buyer could face with a hard market condition, which means the market price will be higher than the risk-adjusted flat price. In this case, in comparison with the previous slides, you will note that the market risk factor is comparably higher than the previous year, which shows us the impact of the hard market conditions. So the natural catastrophe activity and the losses arising from these events are evidently rising throughout the world in the last years. Insurance industry is a key player to help the community and the economy to recover following a natural catastrophe event. However, it is crucial to make some legitimate estimates with the current resources available in hand. In conjunction with the previous slides, reinsurance prices were tend to increase following a major CAT event or multiple CAT events, looking at the historical data. This slide, the upper one and the lower one covers the upper one covers the natural catastrophe losses in total, and the lower one covers the rate online index. So if we make a one-to-one comparison in between, following the major CAT events, we see that we see a hardening in the market right after the major CAT event years. However, looking at the right end of the curve we have, which represents the rate online index, coming to the end, after the HIM events in 2017 and quite frequent losses in 2018, we didn't face any rate online hardening in that respect. We can comment on that. It could be a consequence of the abundance of capacity in the market, which is also a result of the contribution of the alternative capital in the market. We covered most of the factors which are contributing to the CAT price. However, there are some other side factors which we haven't touched upon. Some of them are model related, and some of them are not model-related factors. For instance, the presence of a secondary unmodeled peril will have an impact on the CAT price. Assuming a CAT excess program with an earthquake and flood coverage, if only the PML calculations rely on the flood risk, and if there's a significant earthquake exposure, then the reinsurer will make some kind of a loading on top of the flood exposure loading. In addition to this, the data quality, the granularity, and the capture date of the data, the exposure data, plays a crucial role in the CAT price. There's a favorite saying in CAT modeling, which is the garbage in, garbage out, meaning if the models are fed with poor quality data, the level of uncertainty of the model by nature will increase drastically. It is important to collect the exposure data on AZ basis, covering all live policies with the occupancy type, like the householders, commercial, industrial policies, building and content splits, the business interruption exposures, the policy deductibles, and co-insurance details is quite crucial. And in addition to that, the granularity plays an important role. So if available, the exposures has to be managed and collected on CRESTA level, or if it is possible, in a more granular way, they should be collected on geocoding data. And another factor playing a role in CAT pricing is the loss records, which we haven't touched upon. Apart from all these exposure-related issues, the loss record coming from the previous year will also have an impact on the CAT price. If the treaty, which is subject to the CAT pricing, is a loss-free, then it will be more easy to get lower prices. Apart from all of these, the balance between the supply and demand is another crucial factor playing an important role in the CAT pricing. So, as we mentioned in the previous slide, the role of the alternative capital being still there and having a surplus capital helps the reinsurance buyers to achieve their targets with more compatible terms. However, there is a discussion in between the market experts if the thing that we are seeing right now, if it is the end of the cycle, or there are some discussions and some expectancies on the lifting off of the cycle. So what we see in the couple of previous years, the reinsurers are more tend to rely on some more tailor-made approaches in respect of each and specific line of business and in respect of each specific customer. So most probably we will see a different era starting from here, and I believe we are not going to be seeing strike market hardenings in the next couple of years' term. I would like to thank you very much for your patience, and I would like to thank the association and Mr. Pierre Salameh. If you have any questions, I would be delighted to answer.
Thank you for your valuable contribution and presentation.
Thank you.
Any questions? No catastrophe question, please.
Teşekkürler. Görüşmek üzere. Tanıştığımız memnun oldum. أمي تركية. أوكي. يعني هلا I think إنه ما في حد إذا حدا حابب يسأل سؤال لمستر بيير أو مس إسن أونال. يس في سؤال.
It's a small question actually for the calculation I'm curious to know if you use any electronic or software calculations for the OEP, AEP. What do you use, and how do you manage it? I'm sure all these statistics are not run manually. So I'm just curious to know what system are you using. Thank you.
Thank you very much for the question. The outputs that you have seen on the presentation are driven from our internal CAT model. The inputs are taken from a vendor model. This is the output driven from a Turkish earthquake model, from a single seedant. We use the vendor model RMS. However, for the dynamic analysis we made internally for the financial analysis is a software we purchased from a broker house. If you would like to hear the name, I can give it afterwards. Thank you. Not to market them.
Any other questions? Okay. Thank you, Mrs. Esen Onal, for your fruitful presentation. I think we have to wait, Dr. Waleed, or shall we start?
Yeah, we can start.
We can start. Okay. Mr. Deepak Mishra, you can say your speech, and I think Dr. Waleed told that we will start at 11, so we can start now with you.
Yeah, we can start now.
Okay, please.
Yeah. Good morning, everybody. Thank you, the organization giving me an opportunity to present this agriculture insurance. So, as you know, the agriculture insurance is gaining momentum in different parts of the world. So, it will be very nice to present here. So, let me introduce myself first. So, I am heading the agriculture portfolio at JOFICO Reinsurance Brokers in India. And I have a qualification of BSc Agriculture, the basic agriculture education. Then I have done rural management from one of the premier institute in India. After that, I worked for 7 years in underwriting underwriting department of different companies in India, comprising of ICC Lombard, L&T General Insurance, and then Cholamandalam General Insurance. And I joined BODA in 2014 and still continuing. So it is almost 5 years I'm working for BODA. So something about my company. BODA has a presence throughout the world, and we have internationally, we have physical presence in 9 locations, and in India in 23 locations. So currently, we are working with almost in 70 plus countries with more than 350 clients. So few of the milestones for BODA. That they have BODA started their business in 1943, so we have celebrated 75th year last year in 2018, and we are the first Indian broker to accredited by Lloyd's. Few awards for BODA. Now coming to the agriculture. So agriculture, if you see agriculture, the Indian agriculture is growing very fast in a rapid pace. So something about Indian agriculture, that is the total number of farmers in India is around 120 million, to be very precise 118 million. Contribution as on GDP is around 15%, which is significantly higher, and compared to the other countries like US and other countries. And then the farmers subscribe to the crop insurance is around 30%. Then the agriculture is mostly depend on the rainfall. Around 75% rainfall occurs in the monsoon season. That is from the June to September. Then this agriculture provides almost 50% of the employment, which is very high compared to the other countries where it is quite less. So when you are coming to the agriculture, so everybody should know what are the crops to be insured. So I have categorized different type of crops. So first of all is the food grains, which contributes the major of the crop. So that is the paddy. Paddy basically the rice. The other name of the rice is paddy. So rice and wheat are the major. Rice, wheat, and maize. These are the three products which are the major contributing to the agriculture. Then the oilseed crops. Then the vegetables. Then plantation crops. Then fruits. All that, the spices. Nowadays, the contribution of the medicinal crops is important, and if you, see most of the people are now going for the naturopathy, the Ayurvedic. So the importance of the medicinal plants also gaining momentum. See, this is basically why I have given this chart. This is because of the crop, how when it is planted and when it is harvested. So each country has different crop calendar. So I have based it on India basis. So each country has different crop calendar based on their monsoon and the rainfall requirement. So one of the major contributors to Indian crop insurance is that credit network. So a very strong credit network is there in India. So each farmer is given a card like your the Visa card, some other card. So you have a Kisan credit card. Kisan means the farmer credit card. So terminologically they have mentioned is that the local language as Kisan, the farmer. So farmer credit card. Then the farmer can utilize that card twice or thrice in a year to cultivate any kind of crop. They can withdraw the money from that card for their use of fertilizer, seeds, anything, whatever the supplementary activities also. And if you see the total size of the is around 666 billion, so which is quite high. Then coming to the history of the crop insurance in India. So everybody talks about the crop insurance. India is gaining momentum. There is talk about this crop insurance, but it started quite much before. It is around 70s when the crop insurance started. Then in 80s the comprehensive crop insurance came into picture. Then this National Agriculture Insurance government takes active role in that crop insurance, and they formulated that National Agriculture Insurance Scheme. So from there, actually, the crop insurance has started. And later on, it comes to the farm income insurance, which is more popular in the USA. But somehow, it did not click in India. There are certain reasons for that. We'll discuss later on. Then coming to weather-based crop insurance scheme. So currently, this is one of the scheme which is most parts of the world, they are using this scheme. This scheme is based on your satellite data or the weather station data. So there will be some triggers for this scheme. Based on that, the farmers will get the payout. Then the modified NI scheme. So there are some loopholes in the earlier scheme of that National Agriculture Insurance Scheme. So the government, along with the experts, they came out with this modified scheme. That's why it is called the Modified National Agriculture Insurance Scheme. And the current use of this Pradhan Mantri Fasal Bima Yojana, this is a Prime Minister's scheme. So this is because of this, the premium has reached to almost $4 billion in India. Then coming to what are the silent features of this, the Prime Minister's schemes. So covered all oil seed, food crops, then oil seeds and the commercial or horticulture crops. Compulsory for the loany farmers. if a farmer takes the loan from any of the financial institution, whether it is a government institution or the private institutions, the farmer is automatically covered. So once the credit goes to the farmer, it is automatically deducted from his account. The insurance premium is automatically deducted from the farmer's account. And the non-loany farmers, those who are not taking any credit or in loan from the financial institutions, for them also it is applicable. And these almost all the perils are covered. The basic perils are this is based on area approach. Area approach means the certain area all the farmers will get the same payment. If let's say same acre of land is farmer, a hectare of land is cultivated, so the farmer will get the same amount of let's say one crop is rice. For rice cultivation, let's say 1 hectare of land one farmer has cultivated. So in that particular area, so all the farmers who are having the same 1 hectare of land will get the same payout. And so basic perils are covered: the drought, flood, hailstorm, on the cyclone, pest and disease. These are the basic, any of the crop insurance, these are the basic perils which are covered. So after that also the prevented sowing. This is a new feature, I mean you can say. When the farmers see their, sow their seeds in the field, because of, deficit rainfall or because of less rain, the seeds do not germinate. So because of that, this is covered, the prevented sowing cover has been introduced. Then the localized perils. So if you see the localized perils, they vary from different region to region, different geographical area, it is different. So whether it is a hailstorm or any, the landslide in the basically the hilly areas, the landslide occurs. So that is also covered. Inundation. And then let's say here also, if you can, yesterday I am coming by road, so there is a sandstorm. So that is also localized. Sandstorm, it does not that the entire Jordan, it will be sandstorm will be there. So it is a localized peril. So that can be also covered as a localized, peril. Then the post-harvest losses. Sometimes what happens, the farmer has, grows the crop and they harvested and they do not have that much of space or the warehouses where they can store. So sometimes they put in their field, the farmers, because they are very poor and they put all these crops in the field. So by that time, if it is any cyclone comes or any peril comes, so for that reason, it is the post-harvest losses are also covered in this scheme. Then the another feature is on-account payment. So on-account payment means, let's say the farmer actually sown the seeds or planted the crops in the field. So because of deficit rainfall or any other activities, if the crop failures, then there is some kind of on-account payment. That means mid-season payment to the farmers. So that they can grow the crop again. Let's say, for example, rice. Rice is planted, in different times. Let's say in the 15 days gap, 20 days or 1 month gap. Some varieties are there, even if the short duration varieties. So if we will pay the farmer the on-account payment or the mid-season payment, then they can replanted that crop, so that his income will not be that much affected. So coming back to the silent features of this scheme, what are the premiums are fixed for 2% in the Kharif means summer, and 1.5% for Rabi, and 5% for horticulture and commercial crops. So any crop in the summer season, the premium rate will be 2% for the farmers, not the exact rate, because it is the actual rate calculation. For farmers, farmer will pay only 2%, and the rest amount will be paid by the government. The government, there will be federal government as well as provincial government. So it will be on the 50-50 basis. Same for the winter crop as well as for the commercial crops also. Then upfront premium subsidy by the government. Government provides the premium subsidy based on the estimation of the insurance company. So when the claim will be arise, so the insurance company or the implementing agency, they cannot follow the government for the premium. So that's why the government is providing the upfront subsidy, so that if anything happens, or if the, for the better management of the claims, so the claims can be distributed on the time. Then comes the single data series of the used for the crop cutting experiment. CC means crop cutting experiment. Basically, it is the estimated the estimation of the crop. And so, how does it is related to this crop insurance? See, every government, any of the countries, so they have their estimation of the production. Let's say wheat, maize. So they have a production. This much is the total production. So how it comes? So it comes from the field, from the area, from the village, or the sub-units, whatever the sub-unit, district level, whatever. So in the sub-unit level, then it comes to the national level. So single series data means the same data can be utilized for the claims estimation and the payment of the claims. So the farmer cannot complain that I have grown this much of crop and I am getting the less payment. So the same data, whatever the data for the government is, whatever the data is collecting from their agencies for the production data, same data will be used for the claims estimation. So there will be no ambiguity for the farmers. Then there is no cap on the premium and the sum insured. So whatever the financial institution provide the credit to the farmer, so the entire amount will be insured. And there is no cap in the premium means, so whatever the actual premium will be come out, so that premium will be charged. Though there will be subsidy from the government, but the actual premium, whatever the actual premium will be come out, so that will be charged. Then this is one of the feature, clustering of the districts. So there are, you see, the district is one of the hierarchy in the geography of, for the governments. So the district actually was one of the unit in this, how the Indian, the administrative unit are there. So if you go to the national level, national is divided into different states or provinces, and the provinces divided into different districts. So earlier the schemes, there was in the district level was there. So in the new scheme, what they did, so they cluster few districts, let's say 4 or 5 districts, they clustered it. So it clustered means it should not be adjacent to each other. So let's say one state is there, one province is there. So in that same province, so maybe one district in the higher side, in the lower side, east, west, whatever. So it is based on the risk. Low risk, high risk, and medium risk. 3 categories of risk they have identified. Based on that, so they have clustered the districts. And it will be the better administration of the for the implementing agency or the insurance company. What will happen if the district will not be clustered? Then there will be a few bad districts. So none of the insurance company will not implement that in that particular cluster of that bad districts. So that's why the government, they have categorized or they clustered the districts. So there will be good, there will be some high risk, low risk, and some medium risk, like that. Based on that, so they have the cluster. So you will see one province, there will be 4 to 5 clusters. Then the coming to the excessive use of the technology. So in the new scheme, there is technology has been used very much. For example, they have used the mobile smartphones for this sampling of the crop. Then there is a portal. They have developed the nationalized portal. So every farmer, so they will have the access. Different units are there, so they have the access. They will be enter into the portal, and they will insure. So, and the government will have the data of the farmers also. In the same portal, the government will have the data for all the farmers. Earlier, what is happening, so though the data was there, but there is no certain website or the portal where so everybody can access the same data. So very recently, 2 years back, so they have developed the portal, and in the portal, everybody is using that same, whether the insurance company, whether the surveyors, then the farmer organizations, the government. So everybody is using the same portal for the different data. Uh, then the government, role of government as a reinsurer. If the total claims comes around 350% of the premium, so over and above of the 350%, the government acts as a reinsurer. Whatever the claims will be there, so it will be payable by the government. So few of the points also discussed in the previous slide. So more detailed into that. So I have already discussed the sum insured as the scale of finance. The scheme is implemented by the Minister of the Agriculture. Then there is a tender process. So how there are different companies who are implementing. So how the company will be selected? So they will be selected on the basis of the merit. That is means a tendering system. So let's say for one province, so all the companies approved by the government, so they will be participating in the tender. So based on the tender, the L1 will be selected, and that company will be implementing that in the cluster which they have selected. So cluster is the unit where they put the tender for the tender. So allocation on the district basis or cluster basis. Currently they are following the cluster basis. So in very rare occasions they go for the district, being the highly risky district or something like that. So they go for the district. Mostly it will be the cluster basis. So the premium is on actual premium. Then government provides the subsidy. This is already discussed. So claims liability is on the insurance companies. Government provides the subsidy, but the entire claims liabilities with the insurance companies. So as I have discussed, there is an indemnity level of 70%, 80%, and 90%. So different indemnity level based on the risk. And the data, the threshold yield on the trigger point, they are calculated based on the 7 years. So now they have changed it to best 5 years. Earlier it was 7 years. So this year they have changed. And the excessive use of technology also we'll discuss later on. Mostly use of the single phones, mobile smartphones for the crop cutting experiment and the transmission of the data. So how the transmission of the data helps in the better claims management. Let's say the company and their agencies, when the crop cutting is done, basically the claims process, they go to the field. In the same phone, they recorded the yield amount and the entire process. And the entire process is linked to the server. And the data is stored in the servers. If somebody complains or some issues arise, that point of time it will be evaluated. What is the correct one? So in that basis, nobody, none of the farmer can be, cheated from the insurance company. So the farmer will get their, claims amount based on the merit. So this is a very, transparent process. So this is what is the contribution? Why the scheme is so successful? Then first one is that single mandate offered by the government of India and the say federal government and the provincial government. Then the subsidy varies from different based on the actual premium. So subsidy varies. Let's say actual premium is 10%. And the farmer pays, let's in the summer season, farmer pays 2%. That means the 8% is paid by the government. Then in some other crop, let's say the actual premium is 5%. Then the farmer pays only 2%. So the 3% is paid by the government. So based on that, the subsidy varies from the 50% to around 80%. In some cases, is more than 80% also. Then the use of the available government machinery, that is very much important. So what is the role of the government machinery? See, if you see the claims management, most of the cost actually they goes for the claims management, being a huge scheme for the claims management. So currently what the government is using, the current the production data, the methodology of the production or estimation of the production, they are using the same machinery from the claims calculation. That reduces the cost, the cost for the claims management. So that is one of the feature. And there is a better coordination between all the insurance companies and the government also. The operating expense, as I have discussed, operating expense comes to low. Then the farmers, the premium rate, that is 2%. It is affordable by the farmer. Earlier, the farmers were paying 7% or 8% for that crop insurance, and drastically it has been reduced to the 2%, which is quite low. So coming to the claims management side, the successful implementation, use of the smartphones, already I have discussed how the technology is used, transferring of the data. Then there is a geocoding of the experimented field. That means where the crop cutting is done for the claims estimation, that itself is geocode, that field is geocode. So that, if in the future, if there is any issue, any issue will be arise, then it can be, tagged to that, it can be verified from there. Then OTP verification. Everybody using the smartphone nowadays, all the financial, transactions are through the OTP and different. So it is also OTP also is. So if you log into the system, so in the smartphone, the OTP will come, and based on that, so everybody will not that access. So you have to register for that. Then coming to the weekly video conferencing. This is one of the feature where the central government, the state government, and different stakeholders come together at a single point. Weekly video conferencing will be there. Issues will be discussed, and whatever the the discussion point come out, it will be resolved through different, whether it is falls on the category of the federal government or the provincial government or the implementing agency or the insurance company or the claims management agency, whoever is implementing in the claims. So which category it falls, so it will be discussed there and it will be resolved. So this is one of the good feature, that video conferencing, weekly video conferencing. Then this incentive to the field staff, which is very good. Because of that, whatever the agencies or the other organizations who are actually working in the field, so they are motivated. So direct monitoring from the PMO level, PMO is the Prime Minister's office level. So Prime Minister is quite involved in the particular scheme because it is a pro-farmer scheme. And the farmers are one of the, politically linked also. See, every government has their motto also, so it is directly involved. The Prime Minister's office directly involved. Appointment of a CEO for the PMAY. So this is a very rare case. If you see from the government side, none of the cases you will not find any kind of CEO terminology. So this is the first time from the government side, one of the administrative officer, the highest level of IS officer has been given the CEO for that particular PMAY activities. So these are also a few of the success factors already you have discussed. Coming to the statistics. The scheme started in 1617, and this is the third. We completed the 3 years. The third year data is not available correctly. If you see the numbers, this is I'll come to the next slide, and then I'll go back. Yes. If you see this slide, if you see in 2013-14, so the premium was only 524 million. And currently it is, this year it will be touching around the 4 billion. So huge jump. If you can see the 2015-16 and 16-17, it is almost 4 times. It is because of this scheme. So this new scheme, PMAY scheme, so the premium has been, the fourfold. It has been jumped to the fourfold. If you see this is the province-wise data I have shown. So how this is around the 4 billion market, and how the rate. If you see also the actual rate, so it has been increasing. I mean, year-wise it is increasing. So there are two reasons for that. Why it is increasing? See, earlier the data availability was not that much good, and currently the availability of the data, the use of the technology. So because of that, the rate is also increasing. Because when the data was not there, I mean, there was issues in the calculation of actual premium. So currently, whatever the rate is coming purely on the actual side, and because of that, also the modeling is used also. So based on that, so the rate is going on the higher side, which is good. So what already we have discussed what are the risks covered in this scheme. So coming to the pricing methodology, on the premium side, this is the basic underwriting guidelines everybody follows. Historical yield data, minimum 10 years of yield data is required for the pricing of the crop. And the data cleaning. Why the data cleaning term is used? If you see the field level data, sometimes there is a gap in the data. So for that, data cleaning is required. And the threshold calculation, then the detrending. So use the statistical method, because the 10 years of data earlier and whatever the data was before 10 years, because that point of time there is no use of the agriculture was not mechanized. Then there was no use of technology at that point of time. The irrigation system, all that taking into account, we need to have the detrending for that. Then this average burning cost, then the pure risk premium comes out. On the loading side, the heterogeneity loading we do because of that. And the data uncertainty, because sometimes what happens, the current year data is not, let's say this year, 19 data is not available for the pricing of this current last in 19 data is not available for this year. So for that reason, we use that uncertainty factor. Then CAT loading, because India is prone to different, CAT perils. So for that, different geographical, based on the geographical location, we do that CAT loading. Then the multi-year loading. Sometimes the tenders come in multi-year, 3 years basis. So for that reason, this loading is required, because once the threshold is fixed for the 3 years, then if the threshold is not increasing, then we need to, load the data based on the, different factors. Then comes to the need of the pricing discipline. What kind of, pricing discipline required, and why it is required also. You see, the rainfall is one of the major, factors for this agriculture, and for the yield index insurance. So rainfall, actually the rainfall varies different geography to geography in India. So that is also one of the. Then approximately, if you see the crop insurance, the different level of indemnities are there also. So in the different level of indemnity, how the risk, when you are doing the clustering is done on the high risk, low risk and medium risk. So in that also the discipline is also required for that. So already we have discussed few of the points in the successful measure drives for the growth. Then coming to the CAT events in India. So see the India different perils, different provinces has different statistical figure based on the when you are doing the pricing. That is one of the factors for that. And if you see the eastern part of this India, they are more prone to the cyclones. And if you see the severity also, the eastern part is more severe than the western part of India. And if you see the state like the coastal, the Odisha, if you have the geographical idea, the Odisha, Andhra Pradesh, on that, basically the coastal on your right hand side, if you see they are more prone to cyclone. Every alternative year there will be a cyclone. So these are some statistical data for the CAT events in India. And this is the geographical, how the different, drought is one of the factor where, the loss of agriculture because of the drought is around 60%, 50 to 60%. So this is, I have defined how the drought map, basically where the severe drought, the moderate drought. So based on that, the pricing can be done. Thank you very much for your patience. And if you have any questions, so I'd like to answer that.
Thank you, Mr. Deepak. Good morning, everybody. I would like to give you a brief CV on Mr. Deepak Mishra. He's currently working as a senior general manager at BODA broking reinsurance brokers. He is an agriculture graduate and earned a postgraduate diploma in rural management. He has over 11 years of experience in agriculture and rural insurance, including reinsurance. He is a fellow from Insurance Institute of India. Prior to joining BODA, he worked in a junior to middle management capacity in premier insurance companies in India. Currently, he is heading the agriculture portfolio at BODA. During his tenure with insurance companies, he worked in product designing, underwriting, claims management, vendor management, and process development for yield-based insurance and weather index insurance. At BODA, he is involved in placement of treaty and facultative programs, reinsurance program design, consultancy of agriculture and livestock program in Asia, Middle East, and African regions. We thank Mr. Mishra for being with us here and for the valuable information on agriculture insurance. If you have any questions, please. No questions? So you understood everything he said, huh?
Okay, thank you, everybody.
Thank you, Mr. Mishra.
Yeah.
Thank you, Mr. Deepak Mishra, for your informative presentation. And now we'd like to invite Mr. Imad Hajj, board member of Jordan Insurance Federation, to honor the head of sessions, Mr. Pierre Salameh, and Dr. Waleed Zurub. أكيد حكينا دكتور وليد زارب. كمان we would like to invite Mr. Pierre Salameh to honor Mrs. Esen Onal for her great presentation. We would like also to invite Dr. Waleed Zurub to honor Mr. Deepak Mishra for his fruitful presentation. Dr. Waleed? Yes. Okay, ممكن هلا بس group photo please? Yes. اوكي بس دكتور عماد كرم دكتور وليد كرمت؟ No? Yes, لأنه هي بس she just want to make sure إنه yes. Okay, we will stop our session for half an hour for a coffee break. Generously hosted by the organizing committee, we would like to remind you to confirm your travel information with our information desk in order to guarantee your airport drop-off. Kindly make sure to be back at 12:30 to start our second session for today. Thank you. Thank you.
This is traditional scarf.